Hello and welcome to Policy Watch, your packed snapshot of the top business and policy headlines of the week, their context, their relevance and impact. I'm Govindraj, Ethiraj. Punjab is in the news once again for mortgaging properties to raise funds to fight a severe financial crisis. The mortgaged properties include old district courts, jails and residential complexes, and even an ashram that houses widows. According to reports, the small state of Punjab has an outstanding debt of over 113,000 crore rupees. Now, the larger question is, however, the state of state finances. With increased devolution, it is becoming imperative that the spotlight be turned on state finances. India's most industrialized state of Maharashtra, for example, has a debt of 338,730 crore or $51 billion, making it the most indebted state. Now, there is nothing wrong in that in itself, but things can go wrong if there is a slip up on the income side. So, what are the larger challenges of state finances and how can management and monitoring be stepped up? What does the new order of devolved central government finances mean? To discuss this, I'm joined by Madan, Sabnavis, Chief Economist of Care Ratings, and Debopam Chaudhari, Chief Economist of Zyfin Research. Gentlemen, thank you both for joining us. Debopam, let me begin with you. This is a new order, right? Funds are being devolved to states. States are controlling more and more funds. But we as a country are not completely aware because different states are managing their own finances. But what's really happening? Is this a cause for concern?
You cannot classify all the states into one ring because states rank as per their capacity to perform. And if you look at so I was reading this interesting report by India Spend which had categorically pointed out to certain states where there can be a major problem. Maharashtra, Tamil Nadu being one of the major states. So if you look at Maharashtra and Tamil Nadu closely, they in fact rank high amongst per capita GDP. So if per capita GDP is strong enough, prospects of further growth is there to per capita GDP, then I don't think there is a significant risk to the top performing states. However, the story can be different in the states which rank like in the lower rung, maybe the last 5 or the last 10 states in terms of per capita GDP. There that can be a problem.
Okay. Madan, we've always focused on, at least maybe we as in media, maybe analysts have focused on the sum of the parts. Is it time that we also start looking at the parts themselves?
No, in fact, when you're looking at state finances, to my mind, if I have to make a general statement, I would say that state finances are definitely better managed in the center for the simple reason that we have the FRBM rules which tell you as to what kind of fiscal deficit you can run, what should be the ideal the debt to GDP ratio. And most of the states, if we have seen, they actually operate within these limits which have been placed. Now, the whole issue is that when I have debt increasing, am I to get worried or not? The answer is, of course, yes. But I think as long as we are playing within the rules of the game which have been set, I don't think there's any serious problem. In fact, I think more importantly, I think today what we've seen, the contingent liabilities of state governments is something more important, something which is not really included conventionally in the concept of debt. And that's something which we have to pay attention to. So just to go back to the examples which you were giving on Tamil Nadu or Maharashtra, Maharashtra seems to be a better place because if you look at Tamil Nadu, the kind of losses which have been building up for the discoms is something which is actually also the burden of the state government. So I think we should probably take a broader view when we're looking at debt of state governments.
So Debopam, is that something first of all you concur with? I mean that the quality of state finances may be better than the federal?
That is very much possible because a little while ago I was talking to you about this metric which comes out of this report itself, where if you subtract debt to GDP from per capita debt from per capita GDP, if you rank these states, you will see that some of these states has a huge amount of surplus GDP, per capita GDP left with them, which we essentially in economic terms call effective per capita GDP. So Maharashtra, Punjab, Goa, Tamil Nadu, these are the states which feature in the top 5 states. And if they have such surplus cash, which definitely can be utilized in their development, building the future prospects of the state.
Right.
And if the states are serious about blocking leakages, then sky is the limit.
Right. Okay. Madan, let me put the question a little differently. So I referred to the example of Punjab, which is actually, and it's been doing it for a couple of years, mortgaging assets or finding it a challenge to pay salaries. What does this mean? I mean, finally, we are a sort of a federal structure. There is mobility. Some states facing deep financial crisis, other states doing well. What can happen?
No, in fact, the case of Punjab, which you're talking of, and what they're trying to do, I think it's quite commendable, because the important part is that the state governments need to realize if they have a problem, and then you say how we're going to address it. Because we should remember that normally when we look at state governments, we tend to look at it with a corporate eye. So we keep thinking that they have to be profitable, they have to be efficient, they should be spending only on development, not on non-development. But if you look at the way in which state governments function, they do have a number of political and social commitments which they have to adhere to. So if we're talking of Punjab, for example, giving free electricity for agriculture is something which is of paramount importance. There would be major repercussions in case it's not given. Now the thing is that once you have this problem, of course we cannot let it go on. How do we really resolve it? And I think selling of property, mortgaging property, I think that's a right way out. And I think a number of state governments which actually are doing well in terms of the finances may not really be delivering the same kind of benefits to the people, both in terms of development expenditure as well as non-development expenditure.
Okay, so what are the larger lessons here, Debopam? Let me, before I come back to the specifics once again.
See, debt as a tool, you cannot ignore it, because if you look at the tax revenues generated by the Indian government, it's 17% of the GDP. So definitely taxes are not enough to finance our large scale demand for development. If you look at these same statistics for a US or a UK, these range between 30 to 40%. So definitely tax yields in a country like India is low, and hence we have to rely on debt. Now, if I have to draw some analogies, like if you consider US, today this entire US debt loop problem exists because everyone wants to lend to the US, given its good credibility and all of that in economic terms.
And the dollar is a strong reserve currency.
Exactly. So if China wants to lend their extra dollar to US, India wants to lend the extra dollar to US, and hence this entire debt loop problem has been created. Same is the case in the Indian context. If you look at India, some of these good states, high GDP states, Maharashtra, Gujarat, Tamil Nadu, Andhra Pradesh, Karnataka, these are the states where local lenders are more willing to lend rather than in the other states. So if these states are getting money so easily, then definitely they should go ahead and take it. And anyways, if you look at the repayment burden for some of these states, it's not that significantly high compared to the lower run states of Bihar and UP.
Right. So my question is, in some ways, is there a sort of inequality that's being accentuated?
Well, if definitely this will boil down to inequality, because some of the states, because they have access to easy capital, they will continue to develop more, while some of the states which don't have this access will not develop. But some development will happen at the pan-India level.
Right. Okay, Madan, so it's not like we've not had disparity between states or between regions of the country, but does this, the new order, so to speak, wherein more funds are flowing from the center to states, and states managing or in some cases mismanaging their finances, create more disparities or greater inequalities?
I think this whole issue of the Finance Commission and the greater devolution of funds to states is a kind of a misnomer, because we have been interacting with quite a few of the state government officials, and they say that getting more funds does not necessarily mean that we're getting actually more money, because most of them have been earmarked to certain specific schemes which cannot really be discontinued. And even while we can talk at a discussion table saying that you have more flexibility in spending more on health and rather than education, once you have a particular scheme on health, you have to keep spending on that. You cannot really discontinue it. So I don't think they have that kind of flexibility. And when we just say that there'll be more funds, it's more a case of decentralization in terms of, since the operation is anyway happening at the state level, the funds have just been transferred to the state directly, rather than having them first coming to the center, having a centrally sponsored scheme, and then passing it on to the states. So I think the amount of money which the states are generating is almost the same. And what we're talking about disparity, that's bound to be there, because in case you're a more productive state, in the sense that if you're a more industrialized state, you would tend to collect more tax revenue, and therefore you'll be able to spend more. Whereas if we're talking of other states, you have your social commitments and you're not able to generate the same kind of revenue because we don't have that kind of production activity, then definitely there would be a problem of having shortfalls and probably leading to higher levels of debt.
So how does the system they become more alert? I mean, so obviously you have to track more things. There are industrialized states who are collecting more, but there are also highly indebted states, Maharashtra being an example. So how do we develop a system of tracking this more efficiently or effectively so as to be, in a sense, comfortable with the sum of parts?
Well, that's a difficult question at this juncture, because firstly, in fact, data reporting in a country like India is still at a very nascent stage. So it will be difficult to track how they are utilizing the funds that they are raising from the market. However, if you track indicators like the Human Development Index or the Gini coefficient, which are being published regularly by organizations like UNDP, etc., that can be a good indicator as to are the funds that is being raised by these states are being put into good use, or is there a huge leakage, and then non-planned expenditure is by far exceeding planned expenditure.
Okay, and this can be sort of stepped up, you feel? I mean,
absolutely. Data reporting in a country like India has a long way to go.
Okay, Madan, do you concur with that? I mean, the quality of data reporting, more people tracking this?
No, I think data is one part. The second part is how do we really interpret it? Because, again, I would take our own experiences when you're meeting government officials, when they keep saying that we spend a lot on, say, like I think there was one state, probably Tamil Nadu, where they say that they give free saris, free sewing machines. Now, do we actually consider that to be a kind of an unproductive expenditure? To my mind, actually, it's no. While we would say that it's unproductive, but if you actually see that you're buying certain goods which does enter the spending stream, it does lead to higher levels of production. So I think we tend to sort of jump to conclusions when you look at government data. And I think as long as we have the FRBM thing, which I started off with by saying that there are certain norms led, as long as we are operating within those confines, and the fact that we are a developing country and there is disparity within states, and states need to spend money because otherwise nobody else is going to spend it. So I think they should be justified as long as we work within the constraints. So I think the FRBM is the important thing here.
So let me round it up, Madan and Debopam, by asking, Debopam, let me come back to you. What does the story of Punjab tell us? Small state, doing well at one time, racked up huge amounts of debt, mortgaging properties. What's the lesson?
See, the lesson is we need to start diverging into manufacturing now. So the focus in Punjab has been for a long agriculture. After Green Revolution, there has no other focus in Punjab. So there has to be innovations at every 5-year, 10-year points of time. And unless and until there is innovation, there is shift in focus in developing various other sectors within the same economy, such problems will keep on arising.
Okay. Do you want to come back on that, Madan? What's the larger lesson or takeaway from the story of Punjab?
From Punjab, I think there's a good and a bad story. Let's come to the bad story first. Is of course that if you're not going to control the way in which you spend your money, you're obviously going to build up a very high level of debt, which is going to become unsustainable over a period of time. But the good part is that you are trying to address this particular issue. Because trying to transform the state of the economy, to my mind, will take a lot of time. It cannot be done immediately, and that's not the way it's going to happen. So the whole idea is how do I generate more revenue given the fact that certain expenditures cannot really be compromised. And I think selling of assets is also an idea which we at Care Ratings had thought of earlier for certain state governments would be a good way of earning additional revenue, which the government is doing.
Thank you, Madan, for that. Thank you, Debopam, for joining us. We need to go in for a break on Policy Watch, but coming up on the other side, commodity prices are crashing. What is going to be the impact? Stay with us. Welcome back to Policy Watch. Commodity markets world over are falling, and quite steeply. Crude oil is now at a 7-year low or below $40 a barrel. Prices of iron ore, the principal raw material for steel making, have crashed also to under $40 a ton. A 10-year low, by the way. Prices are falling because of weak demand from countries like China and oversupply in many places. Iron producers in Goa, which produces low-grade iron ore, are already saying their operations are unviable, according to reports. Now, the larger question is, which way is the commodity cycle going? What is the damage it can do to producers? How does it benefit consumers? And can it help India's economy still? And what is the longer-term outlook? To discuss this, I'm joined by Amit Bhandari, Energy Fellow at the Gateway House, and Hitesh, Jain, Commodity Analyst at IIFL. Thank you both for joining us. Hitesh, take us through what's the impact? Why is this happening? I mean, we thought that prices will fall and they'll stabilize and then maybe they'll start rising again. Instead, what we are seeing is a steady downward drift. Why is that?
See, the current scenario is quite unprecedented. Generally, when you see a steep fall in prices, the demand-supply equilibrium across the industries auto-rebalances itself. But now what you are seeing, there is a lag in the recalibration of supply and demand across all commodities. The major problem which can be attributed is to the fact that the input costs have gone lower, the currencies have depreciated. So a lot of companies which are producing copper or aluminum, zinc, they are still producing. China is a big problem because they are saddled with overcapacity, the demand is weakening. Let's take copper into consideration. Now, copper is a 22 million ton market and China consumes 50% of the copper, that is 11 million tons. When Chinese GDP used to grow at 10% or 8%, Chinese domestic copper consumption used to grow at 10% on YOY basis. Last year grew at 5%, now estimates are calling for copper consumption to be flat of 1%. So what it translates into is actually excess supply, because when you say Chinese consumption growing at 1%, 0%, every 1% decline in demand leads to 1 lakh ton of surplus. So from 10% to 1%, 0%, that means 1 million ton of surplus. Then who's going to absorb this? Now everybody's talking about India, but let's be realistic. India cannot absorb, or there cannot be substitute for India. Let's compare India's consumption. India consumes 7 lakh ton of copper and China consumes 11 million ton of copper. So who is going to absorb this?
So India is 0.7 million tons and China is 10 million.
India is 7 lakh tons.
So that's 0.7 million.
0.7 million, yeah, exactly.
Yeah. So, but you're saying that this story is being replicated across commodities.
Yeah,
so how did that happen? Because oil has no direct correlation with iron ore, because if we drive cars, or I mean, we are consuming oil all the time, aren't we?
See, I think there has the paper money, which actually also led to big time investment into energy sector or all other metals, that could led to such spiraling in prices. And with China slowing, see, you understand the structural bull run which we saw in commodities. China was a big factor. It was like US has a strategic oil reserves. China also has strategic. They've been actually procuring oil across the globe. And that slowdown in demand is actually having a detrimental effect on all the prices. And it's going to be a long winter, because it seems that most of the industrial commodities basically are trapped into a kind of a bear vortex or bear whirlpool. And I see at least a year or two for commodities to stay at these lower levels, unless you see the equilibrium actually balancing.
Okay, so let's get an energy perspective from you, Amit. So is your sense, I mean, are you in concurrence with what Hitesh is saying in terms of energy at least, or oil?
Yeah, in case of oil, there is of course a slowdown of demand from China, but China is just one market amongst many. Most of the oil consumption, China accounts for less than 10% of the global oil consumption, around 10%. What has happened in oil is that till last year, prices were above $100 a barrel, and they had been above $100 for several years in a row. And because of these high oil prices, a lot of investment went into production. So because of which a lot of new oil started coming into the market. Also, shale oil became viable to produce. Technology developed and prices fell. So what has happened is that in a commodity market, even if there is a small 5-6% surplus, prices can fall drastically. That is what has happened. So unless this spare capacity in shale goes away, prices are going to remain low. And this spare capacity can remain for the next 2 to 3 years at least.
Okay, right. So when it comes to oil, as a country, we are a beneficiary. It's keeping a lot of things down, our subsidies under control and so on. But when it comes to non-oil commodities, things may not be the same, isn't it?
India is a beneficiary. Most of the commodities like zinc, lead, nickel, and copper, we are net importer. And in case of aluminium, a net exporter. So as far as metals like copper and all these commodities are concerned, we are beneficiary.
Okay. Now, but however, on the other hand, we have steel producers, aluminium producers, iron ore producers, who are all obviously complaining.
Yeah, see, the falling prices have put all the commodity producers in a bad shape, and people are talking about actually imposing anti-dumping duties, because China is actually glutting the global markets because they have a surplus at their domestic markets. Now let's take steel into consideration. If you look at the NYMEX HRC, steel prices are trading around $330, $320 per ton, but when you import steel from China, you get at $270, $280 per ton. So
and that's landed.
That's landed. So that dampening the overall prices, and the need of the hour is definitely putting duties. They have already done on certain products as far as steel is concerned, but there is need for inducting or for introducing far more stringent measures.
Okay, you're saying that we should impose more duties in order to make it more viable for Indian companies. Do you agree with that?
Well, in case of steel, I would say that at some point we may have to intervene to protect the domestic industry. But then what happens usually is that taxes which are imposed to protect the industry become sticky and they don't go away that easily. As a consumer, it doesn't benefit everyone that much. So, one has very mixed feelings about this.
Okay, fair enough. So let's look at it at a slightly longer term, right? So you were saying, Hitesh, that you see things remaining like this for the foreseeable future, which is more than a year, right? So what could be the sort of the pros and cons of such a situation? Assuming oil prices are low, most commodity prices, including steel, copper, aluminum, are low. Could it overall be a big benefit for the economy, at least the Indian economy?
It could be, but then you have to understand that the decoupling theory never works, because no country is actually decoupled. Although people compare or people talk about US being a relatively bright spot amid the developed markets, but even US, in spite of such bringing down the unemployment rate to 5%, their GDP growth is still growing at 2.5%, that is well below the historical rate. So I think the economic landscape remains fragile. You will be prone to or subject to a lot of volatility, a lot of shocks, external shocks. So I don't see Indian growth when you compare with other economies would be relatively resilient, but you understand it may not translate into big optimism as far as
right. Okay, so what should we be doing from an oil, gas and energy perspective, Amit?
Well, look, we import 3 million barrels of oil a day. Oil price was $110 last year, it's $40 today. Every single day we are paying $200 million less for importing oil. So the thing to do is, at this point of time, can we do anything to lock in prices at this level? And this can be done if the Indian oil companies, public sector, ONGC, Indian Oil and all, go out and acquire oil and gas fields overseas. And in the current scenario, there are a number of small and mid-sized oil companies globally in the US, in the UK, listed firms which are in distress and which are looking for buyers. So this is a time when when prices are distressed, and ONGC for that matter is completely free of debt. So they can actually leverage this balance sheet, buy up oil and gas fields today, and freeze the oil prices for India for the next 20-25 years.
Okay.
So this is once in a
what would be
generation
the
opportunity.
kind of capacity that these fields that you're talking about would bring?
So I just looked at I'll just give you one example. ONGC in September this year acquired a stake in a field called Vankor Neft. It's a oil field in Russia. It's owned by Rosneft. So for $1.5 billion, they got a 3 million ton per year share of oil. So 2 or 3 years back, a similar deal would have easily cost them $4 or $5 billion. So India needs to tie up about, ONGC had an original target of tying 20 million tons of oil. What we import is about 150 millions. So, whatever we buy, it will be short.
Okay, great. So you're saying, but persist on this strategy of acquiring more oil fields. This is the best time to do it, and your balance sheets are in a strong position.
Yes.
Could the same thing be done in commodities, in other commodities?
See, we're not big players. As we said, our consumption is not big enough. So the enterprising, the people who are actually employed, buying a mine of sheer size in globally, I think it is still not economically viable for us.
Okay, but if you were to look at the China example, that someday we are all hoping that we will grow at 8%, 9% and even maybe 10%, then maybe we should be preparing for this situation, shouldn't we?
There's a lot of time. I think, let's be realistic. I think you will not see that happening for at least for 2 decades or 3 decades. Let's talk about consumption, per capita consumption, because the population size literally same. You take any commodity, steel, cement, aluminium, copper, any commodity, China is 10 to 15 times bigger than us. I think the reforms will take time to come into play, and that growth, to catch up with that growth engine, I think it's still lost at least 2 or 3 decades where we come in par with China.
You're saying 2 or 3 decades, not 2 or 3.
Yes,
okay.
yes.
Many would hope that it is a couple of years. But anyway, so if you were to assume that things are where they are in terms of production, demand and supply, particularly in India, are we seeing overall the economy being a net benefiter?
Yeah, net benefit, because obviously it's quite palpable with our current account deficit narrowing and coming in balance. So we have benefited from the fall in oil prices that should actually lead to rising consumer spending. That has not been reflected in the US, although. But then when you have falling oil, because the benefit has not passed to Indian consumers yet. So the oil prices remain low, and the benefits passed on to consumers, people spend more on other commodities or other things, and then should actually give a spurt in the overall growth numbers.
Right. So the last time oil prices went down, Amit, everyone thought that it would remain down, and people were talking about $10 a barrel and all that, and suddenly it swung dramatically and went in the other direction.
Yes.
Could that happen today? And if so, then where does that leave us?
Okay, one is that yes, that kind of event can happen. I mean, there are a lot of imponderables. Saudi Arabia and Iran could, for instance, there could be political unrest in one of the major producers, or a war could break out in the Middle East. So any of these drastic factors can again lead us into an oil shock. This happened once before in 1979-80 when the Iranian revolution completely threw the oil markets out. And given the volatility of West Asia, we cannot rule out such an event. So which is why, and irrespective of what happens in West Asia or elsewhere, India will still need to import those 3 million barrels a day. So which is why that point that, the prices are low, this is a time, go out, buy something, freeze your costs and protect yourself.
Right. So therefore, if things turn, and they can certainly turn as we've seen in the past, then this is the best time to...
Correct.
Yeah.
But that will be supply driven, not demand driven. So geopolitically, you see a supply side risk and then prices moving higher.
Right.
But demand side, there is no impetus.
Right. So you're saying the demand side, China is going to remain weak. India, you don't see any major movement, and therefore things are going to be steady. We've run out of time. Thank you so much. That's all we have time on Policy Watch this week. We'll be back next week, same time. Thanks for watching.